morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at the results of two somewhat related companies. We're talking about NCBFG for their 6-month period ended March and Guardian Holdings Limited for their first quarter ended March, first fiscal quarter. And certainly some major changes coming about because of fairly significant changes to accounting standards. And let's see how that would have affected their earnings performance or their financial performance and what investors might expect in the coming months ahead. Turning firstly to the parent of GHL, NCBFG, we can see that for that half fiscal 6-month period, the group would have reported earnings per share of just about 8 cents TT, equivalent of 59.5% decline from the 20 cents in the comparable prior period of 2022. Now, the net result from banking and investment activities was relatively stable, up just around 0.2% with 2.3449 billion generated compared to 2.344 billion. Net operating income, however, did decline fairly significantly, 11.7% from just over 3 billion to 2.68 billion TT equivalent, and much of that was driven by a decline in results from insurance activities. Overall net profit attributable to equity holders or shareholders would have declined at 59, let's call it 60%, from 458 million to just about 185 million for that 6-month period. Now, driving that performance, again, notably the one major notable change was that net result from insurance activities, which did decline from 699 million to just about that 338 odd million TT equivalent figure, roughly a 50% decline there, and that would have really weighed on all of the on the operating income or net operating income overall for NCB. Now, from a valuation perspective, NCB is trading at that multiple or price to earnings multiple of about 8.2 times, which does make it relatively attractive on a historical basis to its own multiples over the past couple of comparable periods, certainly from the half year 2020 come forward. However, take that with a grain of salt, because with those accounting changes, it could impact subsequent quarterly earnings, which could bring that earnings figure down just a bit, and future earnings periods, and that could in fact drive that multiple up to some degree. So we're going to keep a very close eye on that. From a market to book ratio perspective, however, NCB is trading at the more attractive lower end with a market to book ratio of just about 1.1 times compared to that sector average of 1.8 times. Now, to put that into context, Scotiabank, for example, does trade at a price to book or market to book ratio of 3.1 times. So certainly using this multiple as a measure of relative value, NCB is looking like one of the more relatively attractive or cheaper on a relative basis valued banking sector stocks compared to all of those others listed on the Trinidad and Tobago Stock Exchange. So at a price of $3.24, well, again, NCB is trading at that price to earnings multiple of 8.2 times compared to the sector average of 13.3 times. That's the price to earnings ratio in the industry sector average. And offers investors a dividend yield of 0.0%, which could be one of the reasons that there is some hesitance in investing in NCB at this particular time compared to the banking sector average of 3.1%. So with higher net interest income in mind, but looking at that decline in profitability driven by that implementation of those accounting standards affecting particularly its insurance segment, lack of dividends, and of course keeping an eye on some of its relatively attractive earnings multiples or relative valuation multiples, Bourse will maintain a market weight rating on NCBFG for the time being. Turning quickly to Guardian Holdings Limited for its first quarter ended March 2023, the group did record an earnings per share figure of 26 cents, which is a 52 or 53% decline from the 55 cents recorded in the prior first quarter of 2022. Now, with those major changes to accounting standards, there is some difficulty in comparing GHL's performance on a historical basis because most of those earnings would not have been restated, with the exception, of course, of the first quarter of 2022. Net insurance and investment results would have declined just about 6.9% from 313 million to 291 million. Net income from all activities declined from 352 to 341 million. There was, however, a major increase in operating expenses of 8.2% from 224 to 243 million. Ultimately, profit attributable to equity holders declined a fairly significant 52%, from 128 million to just under 61 million for that first quarter period. Now, when we take a look at the operating profit by segment, we notice that there was one major impact in terms of segment performance. We can see that life, health, and pension in that orange segment declining from 121.3 million in terms of operating profit to 81.7 million. So certainly a very noticeable decline there from the first quarter of 2022 to its most currently concluded quarter, first quarter of 2023. Otherwise, it was a reasonably good performance from a segment basis in terms of operating profit. Now, again, with the change to accounting standards and reporting, it is somewhat difficult to look at GHL's performance on a trailing earnings basis. So we're going to take a look at the book value per share and the price to book ratio, and we can see that on a historical basis, GHL is trading at relatively attractive levels compared to its own historical levels over the past four prior comparable periods, with a price to book ratio or a market to book ratio of about 1.1 times, so certainly at the lower end of its trading range over the past four prior comparable periods. So at that price of $20.73, GHL is trading at a price to earnings ratio of 4.7 times. Now, again, we're going to take that with a pinch of salt, given that these accounting changes and the adoption of IFRS 17 will, in fact, lead to some major changes in earnings and financial reporting in subsequent periods as well, compared to the sector average of 36.1 times, which may be also skewed given some of the other components within the sector. So with those relatively attractive valuations in mind, keeping an eye on higher finance expenses, but of course the uncertainty that is brought about by that adoption of the new accounting or insurance accounting standards, Bourse is going to maintain a market weight rating on GHL for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or to Bourse, email us at invest@boursefinancial.com. Or, of course, you can check out all of our research, which is absolutely free on our website at bourseinvestment.com. Have yourselves a very safe and productive investing week. Do enjoy your holiday tomorrow, and we'll see you next time on the Bourse Report.